Alrighty, folks, we are recording this Monday morning, but we're going to talk about Tuesday morning. Tuesday morning, we get a CPI print, both headline and core. As I've been warning for 6 months, this is going to be an ugly report given what's called the base effect. There is forecasts that core will exceed 3%. Actually, it will go to 3.1. Again, that is the forecast. We'll see what happens Tuesday morning, but headline will also go up. The good news is the next 4 or 5 months are much, much easier compares, and inflation will likely look like it's falling. But tomorrow could be ugly. We could print something over 3%, which will send the news media wild because they don't understand this has been coming for 6+ months. Taylor, what say you? What are you looking at for tomorrow?
Yeah, you're on the base effect here, and that's rightfully where you should be because that's what's going to drive the number. I think there's kind of 3 interesting components of the inflation that are going to drive things. So the negative is the headwind, tariffs. We know that that's just, overall going to drive prices higher. The incremental increase is up to be debated about. The positive, which does not get worked into core, which is why you see a higher jump in core expectation than anything else, is the fact that oil has remained stubbornly low to a good point for most of the economy outside of folks directly in that industry. And then the unknown going forward is just what happens with jobs. And that's the one that is up for debate. So you got kind of the headwind, which is tariffs, the tailwind, which is oil, and then that crosswind, if you will, which is just what happens with jobs going forward.
Yeah, I will throw one more at you. And this is something I've started to get on the last 3 to 4 weeks because I think one of the things that most people are going to miss is that the inflation numbers, meaning the prints, they're made up of a lot of components, which, as you know, I actually think they're going to be more muted because I think what's happening underneath the surface is we are finally getting shelter inflation, which is the largest component, to come in lower and lower, right? I've been on this for about a year saying that, I think it was like 6% or 6.8%. I'm like, that's not happening in rentals. What the hell are these numbers all about? But I think they're starting to roll off. So I think the disinflation in shelter, which is the largest component, is going to hide or seemingly neutralize some of the tariff headwinds. And of course, I don't think the tariff headwinds are showing up, if at all, yet. Yeah. So I'm in the camp this morning. And again, I'll post this tomorrow, so it'll be spectacularly right or wrong. I think inflation is going to look a little tamer tomorrow morning. That's where I'm at right now.
Yeah, I think there's also just this bifurcation in the market between the goods and the services.
Correct.
Right? So the goods inflation is what's being felt with tariffs thus far. And so you're starting to see the price of goods, whatever it is, generated outside the United States that land on our shore, you're starting to see the price of that go up. So the tariffs are just starting to slowly leak into the economy. But I think more to come on that. And I think the Fed has made it very vocally that they think there's more to come on that front. The other side of the equation is the services side. And I think the services side is showing disinflationary pressure due to what I presume being just a softness in the labor market more than anything else.
Well, so this is very important because, again, depending on who you look at, goods, specifically goods imported, right? You have to add that caveat.
Yep.
That's only about 12 to 18% of the economy based on, lots of different reports I read. Yep. That leaves goods made here, which aren't impacted by tariffs, and then services. That's the key, right? Services are, I don't know, call it 60% of our economy. And if we're seeing disinflation in services and in shelter, I think, again, this is why I think tomorrow is going to print better than expected, because I think people are missing it. I think everybody looked at tariff. Everybody looked at it as a one-step function. And, oh, by the way, it has to come. And then, oh, by the way, even on the good side, I mean, look at what the car manufacturers are doing, right? Toyota came out and said, we're going to absorb a $9 billion hit. So again, think about the supply chain, right? That doesn't end up in the consumer. That ends up in profit loss.
Right. And that's exactly what Trump and the administration were hoping for, right? They don't want to force it through to the consumer. But we'll see how that winds up shaking out. I think it's going to be really interesting to see what they say and what they follow through on, as to, if their shareholders start to pound them based on they're eating too much of it, all of a sudden you might see some of that more leak through into the consumer at the end of the day. So
that's the wrinkle. And I agree with you 100%. But what I want people to realize is I don't think even a year from now, even if you talk about Toyota or any of these manufacturers, I don't think the consumer is going to eat 100% of it. Now, will they eat zero? Of course not.
Yeah.
So the argument is, where between 0 and 100 is it? And I think the Fed is wrong. I think the Fed assumed that 100% of it would land on the consumer. And I think that's just blatantly false.
Yeah. Yeah. Agreed. And thankfully profit margins have been coming into this really, really wide. And so I heard a very logical, pragmatic argument by someone that said it'll be a third, a third, a third. A third taken by the exporter, a third taken by the importer, a third taken by the consumer. And again, those are just round numbers and easy to say, but there is some logical, directional kind of thought process there that I think makes sense.
Yeah. And if you were to tell me, I think that does make sense, right? Is it going to be exactly that? Of course not. But I think everybody's going to take a bite is really what you're pointing at there. And again, I think the Fed is off. I think the Fed has assumed it's going to be a one-time step function. It's going to come and it's going to be nasty. And I just think they're blatantly wrong.
Yeah. David Bernstein made a good argument on a podcast I was listening to this morning, and just saying that it's not going to be one time. He said it's going to be multiple times. And the thought process there is, it's not coming all at once. All of these countries are getting different tariff rates at different times. So it's going to be this kind of staggered approach as to, okay, when does it get felt? Well, the early indications or the early tariffs are actually being felt right now.
Sure.
And that's why you're starting to see goods start to leak higher. Whereas if you ask the average person, if you ask me who studies this and watches this every day, what is the current tariff rate on XYZ country? It's like, who the hell knows? It's impossible to keep track of. So when it actually gets implemented, when the actual figures start to show through, it'll be kind of an ongoing progressive thing. But at the end of the day, we are going to have somewhere near in the ballpark of the highest tariff rate we ever have had as a country. Something is going to be felt.
Well, let's just play that out. Again, you've probably seen the numbers. I think it was 29.6. We'll call it 30 billion. 30 billion was collected last month. It is a record amount for the United States. That's a run rate of 360 billion. And again, I don't know how that doesn't go higher. Right. Because again, that 30 billion could easily be 45 or 50 billion once all of these tariffs take effect. That's $500 billion.
Yep.
That's not inconsequential.
No, it's not. And everyone might say, hey, it's 37 trillion that we're in debt right now. But guys, that ain't going to get wiped clean quickly based on any action. So it's got to be incremental in its nature. And this is kind of helping out that game. Now, the question becomes, when we see the inflationary pressures leak through, can the consumer continue to afford to pay the higher dollar amount and therefore the run rate persists, or does buying just slow and therefore it actually becomes a negative headwind there?
Yeah, demand destruction. This is going to play out really, really interesting. The other thing that I think is happening underneath the surface, and this is really early. This is looking at tea leaves, and I could be completely wrong, but I think wage inflation is about to kick in, because I think what we're seeing is, participation rates at record lows in the job market. We're seeing, migration essentially turn to zero, and eventually companies are going to have to start paying more. And of course, they'll be using technology and AI and all of those nature. But again, I think the underneath the surface might be some wage inflation, which I think is a net positive. Back to your point, can the consumer stand this? Well, if they had 2 or 3 year run of wage inflation 2 points above inflation, that's not a bad thing.
Yeah, I think companies have become hyper focused on not letting that get away from them. So I might take the other side of that. And I know there's a massive argument about AI, productivity, et cetera. And what's interesting is we haven't seen it yet. So there's been this massive CapEx spend, but we have seen no increase in per hour labor productivity, right? You would think that what's going to happen here is you're going to have AI start to replace Johnny or Timmy or Jane. And therefore, there's only going to be one where there was 2 before, and the production is going to stay relatively similar. So therefore, the productivity per hour of labor is going to increase. We have seen 0 of that thus far.
You want to know when that happens? You know this historically.
Recession.
Exactly. You want to see productivity go up?
Yeah.
Have a recession. And I'm like, that's not what you want.
It's funny. I remember back in an MBA class, I had a rock star professor, and he said to me, and this was eye-opening. He said to the class, and this was eye-opening at the time. He said, we as executives know that workers work 33% of the time.
Yep.
And I was just absolutely astounded by that. And this was before I really entered the workforce in any meaningful way. And as he said that, it stuck in the back of my head throughout the entirety of my career. And I looked around and I was like, could that person triple production? Yeah, most of them.
Yeah, most of them can. Yeah. Absolutely. Absolutely. Well, hey, I don't know if you saw this over the weekend. I'm sure you did because you are plugged in and wired into Wall Street. But JP Morgan came out with what I thought was an interesting call. Bank of America still says zero, at least last time I heard, zero rate cuts. But JP Morgan said, hold my beer. We're getting four.
Four. I was just saying, I thought I saw three, four. Here we go.
We only got 3 meetings left, Taylor. What the hell?
That's Jamie Dimon saying there is doom and gloom coming into the streets, and therefore they're going to have to get really, really aggressive.
It'd be clear, if people don't remember this, JP Morgan had one cut in December until recently. This is net new information. It's bad.
What's really interesting, and I was listening to this, someone else's take on it is Trump and his massive desire to lower interest rates. And so lower interest rates obviously is the door open for inflation, right? That's a concern. If you drop interest rates too quickly, inflation leaks back in. And they said, does he not realize that he got elected on the back of Democrats producing higher inflation? And so like, it's this give and take. They were calling it this ultimate irony of like, listen, if you want them to cut and it does reinflate inflation, your party's not getting elected. So it's interesting. And obviously there's a lot of conviction on Trump's side that inflation's a non-issue and that the labor market is a bigger concern, and or it's just they want any way to spur the economy, which is every politician.
Yeah. Well, again, that's everybody. So let me ask you this question again. You're not a real estate guy, but that doesn't stop me from asking you. Last time we did rate cuts, again, September last year was at 50 basis points. I'm calling for a 50. Currently, the Fed watch still says that's zero, which I think is crazy. They should at least have a point there because I'm saying it's coming. But anyways, they didn't ask me. But what I want to ask you is, are we going to get another mortgage rate increase if the Fed cuts? Do you think that's likely?
I don't think so. So I think it's cart, horse, which one comes first. And I think that that's what's so misunderstood here, right? So I don't think rates get dropped and therefore, you know, the 10-year treasury goes higher, forcing mortgage rates higher. I think it's more of the opposite way around, where the 10-year treasury and inflationary predictions, which drives the 10-year treasury, dictates the Fed. So if the Fed's doing their job and they're cutting rates because future expectations for inflation are lower, then you should have, in effect, mortgage rates come down. Longer term, there's much more directional number and data to look at that says when the 10-year comes down, mortgage rates come down. Now, it's not a one-for-one. Let's be 100% clear on that. But I think that if the Fed is doing their job and cutting interest rates at the right time, it's a function of lower inflation. Lower inflation is the function that will bring down mortgage rates.
Yeah, and again, I think the inflation numbers after tomorrow will look beautiful for 4 or 5 months, again, given the base effect. Folks, this is just math. This is why I said this report, last report and this one, were going to be ugly. And I even said inflation is going to look like it's over 3% again. And again, the experts are saying 3.1 core. You know, I guess the last thing to ask you here, and I don't know if you poked around this, but it looks like Fanny and Freddy might be going public, possibly raising $30 billion, making people like, hedge fund guys a lot of money. But I'm curious, do you think when they go public, do mortgage rates go higher or lower, or is this just out of your depth and you don't really have an opinion?
I think it's, unfortunately, I think it's the latter thing that you said there. I'm not sure exactly what the impact of that will be. One side says that potentially if Fannie and Freddie bring in a ton of capital, maybe that means that they could in effect lower mortgage rates, but also it comes with investors' desire to have profit margins, and profit margins remain wider.
Well, I'll give you my take and you let me know if this is rational. As they sit today, there is an explicit guarantee. If they go public, it has to be an implicit guarantee. At least that's my assumption. Could they stay explicit? Probably, but I don't know how you do that. And when I look at the risk profile going from explicit to implicit, that just feels like a wider margin. So where I sit is Fannie and Freddie, rates go up. But to your point, they're going to have $30 billion. It'll be the largest IPO on record, at least based on the article I read. And, maybe that depth of capital lets them to buy rates. Maybe. But
it's just the competitive landscape that they will then enter, and how do they want to do that? Do they want to undercut? Do they want to come in at market rate, et cetera? And that's up for debate. I think and this doesn't have to do with the topic that you're talking about here, but I think it's becoming so blatantly clear of just the different pockets. Obviously, you always have real estate as regionals being so much more important than just the broad national averages. But like where I live in the Northeast, the real estate market's still really tight.
Oh,
And
yeah,
so,
you're still a seller's market in the Northeast. Yep.
correct. Whereas, the southern states are where you have the buyers starting to get the meaningful upper hand over the sellers and coming
Agreed.
underpriced, et cetera. Where I live, they're still getting put on market and you're still getting bids on top of what the asking price is.
Very cool. Well, let's close this out where we started on inflation. So again, I'll give you the experts. The experts say that headline's going to be 2.8, core is going to be 3.1. Do you want to take the over, under, or the number? What do you think? Just ballparking it.
I'm going to take the opposite side of you, just for argument's sake.
I like it.
I don't know that I haven't done a logic. I don't know that I've thought enough about the logic behind it, but you know what? Let's do it.
There you go, folks. This will be published tomorrow morning. We already know who is right. Again, I'm going to take the under. I think disinflation is going to be bigger and broader than a lot of folks, and Taylor's going to take the opposite. So let us know in the comments below who got it right, and one of us will celebrate and laugh at the other.
I think you're going to be laughing at me, for the record, because I'm kind of on your side, but I was taking the other just to be an ass.
I like it. Yeah, I love it. You're great, family. Take care.